portfolio's value swells, and you mistake this concentration for genius, but you're building a house of cards. A portfolio built on a single pillar is bound to crumble when the ground inevitably shakes. And we've seen it happen over and over again. Yet it's a lesson so many of us forgot when we're sitting on a huge gain. The problem isn't just the market downturn, it's being completely blindsided by it. It's the huge difference between a temporary setback that you can bounce back from and losing years or even decades of hard earned savings. It's the difference between shrugging off a bad market year and seeing your retirement plans all tied up to one company's fate go up in smoke. And I'm going to be honest with you, when we were looking at this particular type of experience earlier this year, we decided to take a few $100s worth of losses in trading out of a down stock. When we did that, we traded into stocks that would give us a higher return. Between May and August, we went from being down several $100s to being up the exact same amount as far as the growth of the portfolio. And we still made hundreds of dollars in dividends on top of that, where we're essentially profiting on both ends. That's because we diversified. If we would have just been on the one stock when we sold the stock down, we would have just lost on our capital. It would have set us back however many months it took for us to put that money into the account. It would have set us back however many months it took for us to get that much money in dividends. We still would have eventually climbed back out of that hole, but we would have lost a whole lot of ground. Well, what if there was a simple, time tested strategy that acts like a financial shield, protecting that wealth that you built? A strategy so powerful, it can mean the difference between clinging to one stock until it crashes and confidently building lasting wealth. We're dealing with right now diversification. And today, I'm not just going to tell you what it is, I'm going to show you exactly how to go from being dangerously exposed with one single stock to building a resilient 20 stock design to outperform over the long run. Now, remember, we gave you a very, very detailed core satellite portfolio that we still live by today because you can see it in the comment section, right below the comment section, scrolling across the bottom of the screen. All of those stocks are involved in either our core portfolio or our dividend rotation strategy. So those are all the stocks that we live by on this podcast, right? And some of them you know, and a lot of them you don't because we grabbed a bunch of the most undervalued stock in the current stock market since Trump took office. Stocks that used to be doing $30, $40 a share that are now doing $5 and $10 a share or less. Where if you recognize growth, the potential for that stock to go back to its original position 5 or 10 years ago means that your value of your portfolio is being bought at probably 90% less than what you would have paid for it 5 or 10 years ago. So if it gets back to where it was supposed to be, you're looking at multiplying it by 900%. You're looking at increasing the value of your growth. Now, one of the best parts about a stock when it goes down is that the value of the stocks go down. And that means that if you buy more stocks while the stock is down, when the stock goes back up to where it was when you bought it or higher, you have more shares of the same stock when its value is peaked, which is why I keep telling you guys that this is the best time. If you haven't gotten into stock investments, this is the best time to do it. Yeah, you can get into Bitcoin and other cryptocurrencies. Yes, it is a more volatile market that does have a lot more gains in it. Yes, but for the beginner, the person who is learning what to do, this is the secret to stopping the silent bleed in your portfolio. And finally, investing with real confidence, because we're going to tell you how to get through the complications. And once you start buying and selling a few dozen stocks here and there, you start building the confidence to be able to, and doing the research to be able to trade better. Now, you think your one big stock holding makes you safe, but that concentrated risk could be eating away at your future profits, because we're about to show you the step by step strategy to transform that one stock into a diversified 20 stock portfolio that acts as that financial shield, protecting your money from market crashes. And this is the secret to building a portfolio that not only survives, but thrives. So stay with me, because what you're about to learn will fundamentally change how you build and protect your wealth. Make sure that you guys take that time to like and subscribe as we get through here. Now, to really get the power of this financial shield, we have to look at the moments when fortunes were wiped out, not because people were foolish, but because they put all their faith in one single idea. The lessons from the past and recent market crashes aren't just stories, they're stark warnings written in red ink. So let's start with the dot-com bubble. In the last, uh, in the late 1990s, the Nasdaq index soared as investors poured money into any company with a .com in its name, right? Then, starting in March of 2000, the bubble burst. Over the next 2 years, from 2000 to 2002, the tech heavy NASDAQ fell by nearly 80%, wiping out $5 trillion in market value. Companies like Pets.com, once hyped and backed by Amazon, went bankrupt just months after their IPO. An investor whose entire net worth was tied up in one of those stocks saw it all evaporate. You might think, okay, that was a speculative bubble. My stock is a solid blue chip company. Well, let's fast forward to 2008. The darling then were the titans of financials like Lehman Brothers. It was a 150-year-old firm, a pillar of Wall Street. Yet, when the housing market collapsed, its stock lost 99.96% of its value in 2008 alone, before the company declared the largest bankruptcy in US history. This taught us a terrifying lesson. No single company, no matter how respected, is immune to collapse. Even Tesla can fold once. I do believe we have September 23rd, I think it is, when the tax credit is no longer usable. When that $7,500 tax credit is no longer usable on electric vehicles, and those 55 plus $1,000 Teslas are paired up against $35,000 electric vehicles, the average individual that's buying affordably over the luxury quality of Tesla are going to redirect their attention to a cheaper vehicle. Tesla's market in electric cars is going to waver. Now, Tesla is asking all of his shareholders to invest in things other than cars, like the robots and all the other stuff that Tesla is manufacturing. But the fact is that something simple like a tax credit that fueled the growth of Tesla no longer existing could devastate the progress of a massive company such as Tesla. So nobody's immune. And if you think these are just stories from the distant past, let's look at the hard numbers from 2025. This year has been a perfect case study in volatility and divergence, because in April, The announcement of sweeping new tariffs triggered a sharp global crash, and some dubbed a slump. But in just 2 days, the S&P 500 plunged significantly, and the Nasdaq Composite briefly entered a market bearing, where they were just undervalued for the longest period of time. Michael says that every 10 years, the batteries need to be replaced. Oh, that is not even the hardest part about it, because while the batteries need to be replaced, some actually need to be replaced every 5 years, but others can be replaced every 10 years. They're also maxed out at a life expectancy of approximately between 100 and 200,000 miles of the total life of the battery before the battery can no longer hold a charge. So the more you use it and recharge it, the more frequent the battery dies down, which is a whole nother thing. So you have years lived versus years used, which could expedite the depreciation of the battery. Then you have the cost of the battery, where some batteries are anywhere between $5,000 and $20,000 a battery. And depending on how many electric batteries you have in your vehicle, for it to function at its current mileage rate depends on whether or not you're buying a new car worth of replacing batteries just to keep the car that you have, or if you're just going to trade the car in when it's no longer holding a charge as long as it used to. When the average mileage goes down from 300 to 500 miles per charge down to 150 to 200 miles per charge, you start trading the car in, because you're not trying to pay for all that. The money that it costs to replace the batteries is a down payment on a new car. And those used batteries will need to be processed as waste, which is not eco-friendly. So while the vehicle is supposed to be an eco-friendly image, it takes about 20 years of carbon to make the battery, and then you have waste disposal of the battery thereafter, which isn't green efficient at all. So and then you have to own the one car that you bought for like 25 years before you turn a profit on the car, unless you're renting out the car on like eToro or something like that, where you're renting out the car to individuals who rent from private owners instead of enterprise, putting more miles on your vehicle, reducing the lifespan of your vehicle to pay for the vehicle to pay for itself. Either way, you're looking at either 25 years worth of possession, or like 15 years worth of usage with a $30,000 a year profit off of it, to try to make money off of the car to make it make sense for you. It's crazy. Yet, despite the terrifying drop that we experienced this year, the overall market did recover and even pushed to all new heights by August of this year. But beneath the surface, a very different story was unfolding, because one that highlights the dangers of concentration is clearly there. Because as of late 2025, some of the best performing sectors, including defensive plays like utilities, while sectors sensitive to economic uncertainty like consumer discretionary lagged behind. Michael said, invest in adult diapers, consumer discretionaries. An investor concentrated in a individual sector like utility stock would have felt brilliant, while someone holding a struggling retail or auto stock was likely suffering. The divergence is even more stark at the company level, because even within a challenged sector, a stock like Corvana was up significantly year to date after announcing a critical financial reset, while many of its peers fell sharply. So, the common thread tying all these disasters and wild divergences together is one simple, dangerous word: concentration. So while they tell you to focus in school, you don't want to focus on one stock. It's the belief that you've picked the one winner. But history and the events of this year show us again And again, that this is a fool's errand. Yesterday's hero is tomorrow's cautionary tale. Relying on one company isn't an investment strategy, it's a gamble. And this is why you must learn how to turn that one winner into a resilient portfolio. So, how do you keep these historical tragedies from becoming your personal financial story? You build a portfolio that can actually withstand the storms the market is guaranteed to throw at you eventually. Like Michael said, diversify. Multiple cash streams. You're right about that. You know what's funny? If you have the capabilities to take your paycheck and invest it in your stock portfolio and then deposit your dividends into your bank account so that you can live off of your dividends, you're doing a damn good job. And I mean, it's kind of a what if, but imagine the fact that you have enough money in your stocks where even at 18% interest, 15% interest, you're living off of the dividends of your stock portfolio, where you don't need for nothing. All your bills are paid. You might even have a little bit of spending money on the side. You've got a guaranteed payment option. That's extremely satisfactory, especially taking to account those situations like when we were talking about yesterday about being a getting a work visa when you go to another country. Places like the Philippines will give you a digital nomad visa if you are working abroad from your computer where the company isn't stationed in the Philippines. So if you've got a job in Thailand, you're working that job in America off your computer. You fly to the Philippines on a work visa. You can live in the Philippines for like 12 months and not have to renew your visa every 3 months. And all you got to do is just show them that you have a consistent standard of living that exceeds their standard of living requirements, and that business is not stationed in the Philippines, and you're good to go. Work visas, like when we were talking about yesterday about going to get you a foreign wife, it's easier to get you a foreign wife in person if you can hang out there for a few years and figure it out with the person before you come back to the states. Like going out there, having the money to pay for your American standard of living and extra money to pay for your foreign standard of living at the same time requires you to be able to still be making money while you're in another country. And that's easier to do if you have a portfolio as an alternative stream of revenue. So you've got your primary paycheck off your computer and then your secondary paycheck off your stock options. Michael says a little trickle here and there, and it will become a river. That's a very good assessment. So passive income. That is correct. The true definition of passive income, because honest to God, that so many people misuse the word passive income when they're talking about real estate and drop shipping and building your own business and blah blah blah. If you had a shit ton of work into something, in order for you to start getting paid from it, that's not passive income, that's residual income. If you just threw your money into a stock option and it is still paying you years and years later, that is passive income. Residual income is the effort in setting it up and the effort of making it turn a profit and then benefiting from that profit from months or years to come. Like for example, the actor in a movie, their effort in creating that movie generates the income. The money that they get after the movie is out, and the money they continue to get for back end pay, any back end deals for a movie that they did 5, 10, 15, 20 years ago is residual income from the effort to create the original movie. But if you put your money on that movie's being successful and you're supposed to get a percentage of its proceeds, that is a passive investment that leads to a passive income where you have to put no physical work into it outside of authorizing them to take the money and then accepting money in return. Michael says, still have to do it with stocks too. Yeah, but when you start thinking about truth, the residual effort from researching stocks, researching companies, investing, following the trends, buying, selling. That is still work. And the fruits of your labor is the residual income that you get. But the closest thing to passive would be stock trading, Bitcoin trading, bots, trade bots, because you got to know about the trade bots. You got to know how they work. You have to tune it to give you uh, uh, the most profits that you can get out of it, and then you let it run its course. Look, it just popped up. Oh, look at that again. 3 minutes. So truthfully, we don't really live off of passive. We mostly live off of residual income, but they call it passive income because in either situation, you don't have to continue working for it. The truest form of passive income is when you inherit money because somebody passed away, and all you had to do was put that money towards something else and just let it work. Or even better, if you inherit money and the accountant takes the money and put it towards something else where you did absolutely nothing, that is the truest definition of passive income. Everything else is some level of residual. So let's just go there. He said residual to me is when my investments have been paid back. After that, it's residual. Well, that's exactly the case. That's exactly the case. Your effort in putting your money into the residuals is the reason why it is residual. It is not passive because passive means you did nothing to get it. So, showing up and collecting your inheritance is like more passive than getting money back off of a stock investment, especially since we got to do so much fucking work to make sure we're not fucking it up. Now, the answer to the original question is a concept that's often talked about and rarely understood, which is, as we've been talking about so far, the diversification. At its core, diversification is the financial version of the old saying, don't put all your eggs in one basket. It's a risk management strategy where you spread your investments across a variety of different assets, the way we've talked about over the past 2 weeks, which stocks to buy into and how to set up what to get to set up your portfolio. We didn't tell you how to set it up. We told you which ones to grab to set it up, which ultimately means if you want to grab the portfolio that had like 40 stocks in it, you could spread it across all 35 or 40 stocks, where you put $100 into each one and you got like $4,000 worth of investment across 40 stocks. Or you could put $1,000 into each one and you've got, $40,000 towards 40 stocks. But it doesn't make it does it, it's not the same for those individuals who don't got it all, and they might want to benefit from some risk and then rebalance towards the rest. And that's what we're going to be talking about today. So passive means I don't have to show up to work at 8 a.m. Monday through Friday. Okay, I agree with that. I agree with that. That does kind of give you that. Well, actually, that's not so much passive as financial freedom. That's more a lack of obligation, because you're going to get paid whether you get up for work or not, because you're making money without having to leave the house. But that doesn't mean that you don't have to put in effort, because likewise, you might not have to wake up for work at 8 o'clock, but some people actually have to get up and put that trade in before the stock market closes. So you still have a requirement of effort. You know what I'm saying? You can't just say, screw it, I'm going to walk away from it and not touch it for 2 to 5 years and everything's going to work itself out. No, somebody's got to be watching your stocks. And really the stock market opens at 9:30 in the morning Eastern Standard Time and wraps itself up at 4 o'clock in the afternoon Eastern Standard Time. So between 6:30 a.m. California time and 1 p.m. California time, your ass gotta have them trades in. Because if you don't, yes, a management team makes it passive for you because you don't have to do anything. That's when it becomes passive. So setting up this particular type of stock option, its main goal isn't necessarily to hit home runs with every single stock. Its real job is to smooth out the ride and improve your returns for the level of risk that you're taking, making sure that a big loss in one investment doesn't torpedo your entire portfolio. So the real magic of diversification is a principle called correlation, a fancy word for how two investments move in relation to each other. Assets with high correlation move up and down together like two stocks in the exact same industry. Okay. The power of diversification comes from mixing assets with low or even negative correlation, where investments that zig while others zag work in succession of one another. So think of it like this. Imagine you own two businesses. One sells umbrellas and the other one sells ice cream. On a rainy day, your umbrella business is booming, but nobody's buying ice cream. On a hot, sunny day, the opposite happens. If you only owned ice cream businesses, your income would be a roller coaster. But if you own both businesses, the umbrella profits on a rainy day helps offset the ice cream losses on the same day, and your overall income becomes much more stable. A true domino effect. For every job lost, its effect, three side jobs. That's exactly what happened when they were getting rid of all of those Mexicans. Every person who no longer has a job is no longer paying for other jobs that would have sustained other individuals. So there was a domino effect there. And this is what a well constructed 20 stock portfolio will do for you. Now, a bad day for your airline stock when we told you to get jets might be a great day for your healthcare stock. I can't remember which healthcare stock we told you to grab, but that would be the case. Like I said, it's like 50. Yeah, we got anywhere between 45 and 50 stocks going across the bottom of the screen. Somebody can count it off and tell me how many are down there, but there's a lot there. And there's no point in continuing to expand that list because the more you diversify, the more you dwindle your dividend returns. Because after you have eliminated the majority of your risk, your annual return yield will continue to shrink because you've only got so many stocks that are producing 18% and 15% plus returns. The rest of the stocks are like 10% or less returns. So the more you average the stocks that are making less than 10% with the stocks that are making more than 10%, those are going to bring you down closer to an average of 10%. Now, while the diversification will give you a little less instability, you're not getting as much growth as you would have been if you would have been putting more effort on risk with the 18 and 20% stocks and rebalancing into 10 and 15% stocks, where the overall average would be somewhere around 17% stock. See the difference? So when your tech stock falls, your consumer staple stocks might hold steady. And by owning different types of companies, you can create a cushion. And the gain in some parts of your portfolio helps offset the losses in others, which lessens the overall drop in your portfolio value. And just as important, the panic that you're going to feel, which gives you a lot more stability. Uh, he said $3,541 today for 1 ounce of gold. Exactly. Which gives you more stability when you're trying to do one of those lines of credit towards your stock option. Remember, I did the show a couple months ago about leveraging your portfolio for capital that you could utilize to buy assets or even reinvest into your portfolio, where the profits from your investment would pay towards your um, line of credit with your stock option. How that would work is that you would have money stock options that's not moving, which means that that's not stuff that's being utilized in a dividend rotation strategy. You're going to put that up and leverage it towards a line of credit. You use that line of credit to buy whatever it is that you're going to buy, whether you're buying buying a car, buying a house, or buying more stock options, or buying gold and silver. Then you take the dividends from your stock option and pay the line of credit down over the period of time that they're going to give you that line of credit. Well, if the stock market is maintaining balance or growing, it is not depreciating in value, which would trigger you to have to pay back the loan faster. And that's actually beneficial for you. So you'll see some millionaires and billionaires that have like thousands of stocks where they might have somebody that is literally selling one stock to buy into another stock and vice versa and collecting the dividends to make sure that the stock is getting the most growth that it can possibly get. And then because it stays above a certain level, you can borrow 71% of that and then go and buy a mansion on a riverside or something like that. Like I said, a $5 roll of silver today is valued at $131 per roll. What would a roll of quarters be worth today? Well, that depends on how much silver is in the quarter. Because a $5 roll of silver, actually, you have to determine if that is a $5 roll of nickels or dimes versus a $5 roll of quarters, because that does make a huge difference versus the value of silver. But if you would have, oh, before 19, it would have been worth a lot more. If you would have invested in pure silver coins, the balloons or billiards, the value per ounce, if you have like a 1 ounce coin, would be excessively more valuable to you, especially if everything starts switching from US currency to digital. And then let's say that the power goes out and now you have to have some type of legitimate currency of trade. Being able to trade precious metals is a good way to have backup currency. And that precious metal does not have a currency exchange value. You literally go to a certain location and just sell your coins to get cash in whatever country you're going to, which is probably easier to transport a bag of silver than it is to transport a briefcase full of cash, because the feds will rob you if you have $10,000 plus 64 cents in a briefcase. They will rob you, and then you won't be able to get it back. But if you had like $10,000 worth of silver in a briefcase, there's no law that says that they can snatch your cash. But cash dollars, they consider that, drug money or illegally obtained capital, and they use that law as a way to take any money from you that you did not declare and show documented proof of where you got it from. So they will rob you at the airport if they know that you've got cash money. But if you've got giant bricks of metal, a little bit harder for them to snatch. Because who does trades? Who's trading a block of fentanyl for a block of silver in a briefcase? You will never see it back. Okay, so there we go. A briefcase full of silver. You check them bags, put insurance on that bad boy, so when they steal your briefcase, you you get the monetary value of what the insurance said the briefcase's contents were worth. That way, you want them to rob you at the airport. It's like, gee, I took a $1.2 million insurance claim on this bad boy. You steal my briefcase. Go ahead, steal my briefcase. I want you to steal my briefcase. I'm just gonna put it outside the bathroom, go into the bathroom, and see what happens, because I'm gonna cash in. They took it off a baggage claim. I'm gonna cash in. Then if they find it later, it's all right. I already cashed in. Now, let's address the key points here. Outperforming the market. How can a diversified portfolio do this? It's not about beating the market every single day or every single year. In a roaring bull market like the one that we're in right now, where one sector is on fire, a diversified portfolio will likely lag behind the entire individual market sometimes, depending on what you're doing. But when we're looking at certain stocks, we're looking at certain stocks that are less than 35% growth. And then we're looking at uh, what we've been doing with the dividend rotation strategy, where we're getting like 35% per month. And when you're doing compound interest, that's like 3,500 and something percent return per year. But when you're looking at uh, an average 35% return compounded off of what we're doing with the dividend rotation strategy, which is far better than the monthly dividend stocks that are giving us at max like 19% return right now, between 18 and 20% return right now. And all of the other stocks that don't do nearly as well, where they're averaging between 5 and 10% stocks or less. The very high volatile, high risk stocks that we're using down below the screen down below, I got to tell you, it it's the risk is worth the reward, because right now in the bull market, it is turning a massive profit. Anything over $10,000 in value. Step one, do your homework. Exactly. Well, they said anything over $10,000 that was not claimed on your what you call it paperwork, but it's kind of easier to show where you got a bunch of silver bricks from. Um, but at the same time, yeah, he's saying that high profits, high risk. You're right. But primarily when he's talking about the over $10,000 in value, they typically are looking at the cash dollars, so the duffel bag full of cash. It does not mean that you will get robbed off of, you know 20 gold bars, or, uh 50 silver bars. But the fact of the matter is that you would need like a I forgot the tax form that you have to file at the bank when you withdraw a certain quantity of cash over the level of $10,000 to prove where you got that cash from. Whereas the receipt of purchase from wherever you bought those gold bars from is pretty much all you need, is that, like, I bought them, I didn't steal them, and that's it. Or if you have like a certificate of authenticity that shows that you own them, that's it, that you would need to fly around with if you're going to be taking something like that. But that's a little bit different. He says, read my book, 1001 Ways of Being Poor and the Benefits of Money. Ah, oh my God. That's the truth. Now, another truth: the outperformance is going to come from the risk management. So concentrated portfolios will get wiped out in crashes, even if they're outperforming in a bull market. When the stocks that they're diving into takes a crash, the fact is that they will still be able to make some money before the crash, and you have to catch before the crash the diversification requirements. When your outperforming portfolio is starting to do too good, you want to start diversifying. Now, a diversified portfolio is designed to go down less than an overall market during a crash. So by preserving your capital, you are in a much better position to participate in the eventual recovery, because what goes down in the stock market eventually does go back up. How soon it goes back up depends on the volatility of the market and what caused it to go down. This long term resilience, this ability to stay in the game, is what leads to superior performance over a full market cycle. It's a stay wealthy and grow steadily strategy, not a get rich quick scheme. Every get rich quick scheme has a extreme fallout in a short period of time. Again, I'm going to reference every mob movie, every bank heist movie, every what I got the hook up with Master P, every movie where you went from nothing to something seemingly overnight. You had a short 1 to 3 month great ride. And by the end of the year, here come the feds, here comes catastrophic failure, here comes a trader, here comes somebody trying to steal extra money out of the tape because they're greedy. All of these things that happen. Get rich quick gets broke quicker. Got to think about it. Okay. So you get the why, right? Now, for the practical part, how do you go from one stock to 20. It's not about guesswork. It's about systemic, layered approach to spreading out your money. First, let's identify the exact moment that you should act. Now, typically, the time to diversify is the moment that you become overexposed. If you only own one stock, you're clearly overexposed at the moment, but you might be riding the growth of that extremely volatile stock. Financial experts strongly recommend diversifying when any single stock makes up more than 10% of your entire portfolio. Once a position grows beyond this, your financial future becomes increasingly tied to the fate of a single company, and the risk rises sharply. Michael says the stock market is similar to a wave. It comes in and goes back out. So the wave is best on top, and you'll learn how to run it in time. That's right. So if you're playing with the wave while the wave is down, once the wave goes up, you'll know what to do. And this often happens if you get a lot of a stock from your employer, you believe in the company, the stock does well, and before you know it, your job and your life savings are dangerously intertwined. One of the things that you find out about getting company stock, some company exclusively tie the ownership of your stock to your employment, where over time, if you end up being terminated from the job before the stocks are sold, that you forfeit the stocks to the company because you're no longer an employee of the company. Some companies allow you to sell your stock and give you the value of your stocks as part of your severance package, especially if you're in a company that is not publicly traded. So you got to be careful with that when you're getting stocks from your company. But if one stock is between 10 and 25% of your portfolio, you're pushing your luck. Between 25 and 50% of your portfolio, you are tempting fate. And if a single stock makes up more than half your net worth in your portfolio, you are playing with fire. So once you decide to diversify, you don't just sell your main stock and blindly buy 19 others. You need a plan. So first, think asset allocation. Decide how much of your total portfolio you want in stocks versus other asset classes like bonds, which is lend stable, or real estate. Like Michael says, go into estate sales, buy your stock when it is in the trough, sell it about to crest. That is actually the best way to do it, buying low and selling high. Think OPM. That's we're going to be talking about that in just a moment. Fantastic notion. One of the things that you also want to do is when you think about this, because we're going to come down a different direction, but I want you to think about this. If you bought one stock, and let's say you put $500 into that one stock, and now you want to diversify, there's two ways that you can do that. When the stock rose a certain percentage, you could sell half the stock and then take that and buy into the next stock. There's another way that you can do it. You can sell the difference where the increase is sold, and then you take the difference and buy into the next stock. So let's say it was at $500, it went up to $600. You sell $100 worth of stock, and then you buy another stock for $100. The other way that you can do it is you can, as you're continuously adding money into your portfolio, since you have one stock at $500, if it rose to $600, instead of buying more of that stock, you buy a second stock that is diversified from that stock for up to $500 or $600, so that now you have two stocks that are 50% of your value. You can likewise go in there and do that again the next time you re up on your portfolio and add another $500 or $600 to the next stock, where now you have three stocks at $600, where that's bringing it down to like 33% a piece. You can do that again with four stocks and continue to bring down the valuation of diversification until you have 10 or 5% divided across 15 or 20 or 25 or 30 different stocks. But if you're buying them one at a time, based on the dividend return yield that you're looking for, versus the price per share buy-in versus the amount of capital you have to invest in it, you might decide that I'm only going to buy stocks that are 18 to 15%. And in that area, I might only buy 10. Fine. You know, I might only buy just the ones that are paying dividends and I might only buy 15. Fine. I might only buy the ones that pay monthly. Fine. I might buy 3 monthlies and 5 quarterlies. Fine. Once you decide what you're trying to do, that's when you start looking at what you're going to buy into. He said, I did this weekend and got my return on my money plus profit. Hey, this whole week, I'm getting all of the dividends because we have the ZIM stock, we have the ABR stock, we have the RM stock, PSEC stock, AGNC stock. So that's like 6 stocks that we're supposed to be getting paid for just from last month's trades. And that's all ex dividends that's coming in this month. And we can just add that to the principle of something else. What we talked about in one of our previous shows is instead of putting pennies on a dollar for each trade, you collect all of your ex dividends at one time and then make one big buy into another stock. We're going to be talking about that later on. So, for example, let's say that you decide on um, buying, I don't know, real estate. Let's say we're going to buy 80% allocation to stocks. That's 80% that will be on your 20 stock portfolio. And the rest of your money can go somewhere else because now you build the blueprint for those 20 stocks. And the goal is to diversify within those stocks. You must spread your investments across 3 key areas. First, you're going to be doing geographic diversification. You don't just invest in your home country. Notice when I gave you guys NIO stock, that's China. I gave you JKS. Uh, I think that was China too. It was Asia or India or something like that. I got to go back and look. But JKS is international trading as well. So there were at least 2 different stocks that's in the list that's scrolling across the bottom of the screen that are not American stocks. Your plan should include U.S. stocks, stocks from developed countries in Europe and Japan, and stocks from emerging markets like China, India, and Brazil, which is why I told you guys about the tariffs that was going against India. Because if you were investing in India, tariffs are going to impact Indian stocks. Second is industry or sector diversification. This is the lesson from the dot-com bust. Your blueprint must include different sectors of the economy. We've given you technology, healthcare, financials, energy, consumer staples, and many more, all at the bottom of the screen. The core satellite portfolio covers all of the industries. Getting a few stocks from each one, getting the highest performing stocks from each one, and putting them together into a smaller portfolio than the 50 something stocks that we have going across the bottom of the screen, you still have the best of the market at the bottom of the screen. And you could just pick the best ones out of that group and put them together for the highest dividend paying portfolio that you could put together in the current market. And they all behave differently at different times. Third is company size diversification. Now, your plan needs a mix of a large cap company, which is the huge, stable giants, small cap companies, which are smaller with higher growth potential but more risk, and mid cap companies, which are in between the two. Pick three. I think right now, outside of the dividend rotation strategy, I am buying and holding on 10. I'm buying and holding on 10 of them. But after we covered the core satellite strategy, I have decided not only to buy and hold on the 10, but to see if I can balance out about 15 or 20 of them to be regular buy and holds that I'm not doing the dividend rotation with, to see exactly how much I can sell the difference and then buy back in. Because if I'm holding those stocks for growth and then I sell growth and buy into the downturn while I'm still getting dividends from those stocks, and doing the dividend rotation on the side, I can see even more growth. But the stocks that are buying and held are the stocks that are not going to be taxed as much as the stocks that are being sold every month, bought and sold every month. So I reduce taxation by moving less money around in a stock option, but I make substantially more money by moving the money around in the stock option. So you have to decide exactly how much money you're okay with being taxed with versus how much money you're making in addition to inflation, because with the dividend rotation strategy, you can make 3 times more money per month every month for hitting all the right stocks versus your standing still not being taxed. And you have to ask yourself, if you're off of a $10,000 dividend rotation strategy, you're making $12,000 a year off of that, and then they're only going to take like $2,000 out of that. You still made a $10,000 profit, even with 4% inflation. You're still looking at a $7,000 or $6,000 pocket money outside of your 18% uh, portfolio that would have been sitting still, only getting you $1,800 off of the same $10,000 not moving, or you would have had to put in, $100,000 for you to have $18,000 come back. You got to think about the difference. How much more would you have to put in there for a buy and hold than what you would for a rotation? Each one has its risks, but you have to evaluate how much risk do you want to put in so that you're making more than you're spending when you're dealing with the fees and services of your platform versus taxation and inflation. So your blueprint is essentially a wish list that might look something like this. Of 20 stocks, I want 12 from US, 5 from Europe, 3 from emerging markets. Within that, I want 3 tech stocks, 3 healthcare stocks, 3 financials, and so on, making sure you have a mix of large and small companies. The bank versus stocks give me stocks. Dang straight. The only thing that you're putting your money in the bank for is so that you have accessible in the moment money that is scenarios that requires cash when credit cards aren't allowed. If you can charge it to your card, you can deal with your emergency with your credit card first and then make that payment on your credit card off of the dividends from your stock option, where you can wait for it to be deposited into your bank account and immediately pay that credit card. But in order for you to use your credit cards as emergency funds, remember we told you that you need 6 months to 18 months worth of available spending to cover your standard of living. And if your emergency fund is going to be upward of 60 to 120 or $130,000. Well, if you're looking at a $64,000 a year income, you're looking at probably having almost $200,000 worth of credit cards. So that if you have a standard of living that kind of sucks, then you should be making closer to 60 grand back on your stock portfolio, which is tax exempt for head of household, up to 64,000, and you're generating enough money on your credit cards to cover all of your bills, and then you make those monthly payments on your credit card. Ah, that's the easy way to do it. So now you're not selling stocks to pay your bills. You're taking your dividends whenever they clear, dropping them into your bank account, and covering your bank statement before your bank statement rolls over, which gives you plenty of time to figure it out, because your bank statement happens once every 30 days, and all of your dividends are paid once a month or once a quarter. But every month you're going to be getting money throughout the month. And if all of your bills are 2 months in advance, they give you 2 months to get dividends one time to pay all your stuff back. But never charge to your credit cards what you don't have money to pay for. Leaving money in the bank, you are actually losing money. That is true. And that's why you don't really want to leave money in the bank if you don't have to, unless you're buying CDs or investing in the bank in some way, shape, or form, where while they're in possession of the money that you're turning a profit, you don't really want to leave your money in the bank. He said, use a credit card only if you are able to pay it back monthly, plus only in an emergency. Exactly. So this isn't play money. This isn't just like, I want to go to McDonald's, let me charge it to my credit card. No, you're dealing with essentials, and you're only dealing with the essentials that you can afford to pay back. If you can't afford to pay it back, you don't want to charge it to your card because that's going to cause your card to either be overdrawn or run a high balance on a monthly basis where you're doing more paying towards interest than you are paying towards the principal. And that's a financial loss in and of itself, even if you're operating at 30% of utilization. It's still a loss because if you were capable of operating at less than 10% utilization, if you were capable of operating at 1 to 2% utilization, you would be throwing away less money on interest because you don't need to hold 30. You just need to hold less than 30. But if you hold less than 10, it looks better for you. Money is actually useless unless it is used. You are right. So you don't want your cash to be somewhere not making money for you where you're not able to live off of it. Now, with your blueprint in hand, you can begin the process methodically. You don't have to sell your concentrated stock all at once, which could create huge tax bills. You can do it gradually, one stock at a time. Step one, determine a selling schedule for your main holding. For example, you might decide to sell 5% of your concentrated position on the first trading day of each month. Step two, after your first sale, you take the cash and buy the first new stock on your blueprint wish list. And let's say it's a large cap healthcare company. You own two, and your main stock, slightly less of it exists, and one new stock is now added to your portfolio. Step three, the next month you want to sell another 5% of your main holding, and you use that new cash to buy a second new stock on your blueprint list, perhaps in an international consumer staple company. And step four, you want to repeat this process month after month until you have systemically trimmed your concentrated position and use the process to buy the next stock in your list, filling out your geographic and sector diversification plan. Over 20 months, you will have methodically transformed a single risky position into a resilient 20 stock portfolio. While there's no single magic number, research shows that a portfolio of around 12 to 18 stocks can provide roughly 90% of diversification benefits. This approach strikes a good balance between meaningful risk reduction and a portfolio that's still manageable. For a vast majority of us, researching and managing 20 individual stocks is a full time job, which again is not passive, it is residual. The easiest and most effective way to execute this plan is by using low cost index funds and exchange trade funds. Think of an ETF as a pre made basket. So instead of buying one stock, you buy one fund that holds hundreds or even thousands of stocks, already diversified for you across geographies, sectors, and sizes. Now, this is what some people do, which is an easy play. For me, I prefer the individuals. Because if I'm grabbing the individuals with the highest performance in the current market, with the highest volatility in the current market, I can see the most results in the shortest period of time. Now, as I diversify, because again, you don't have to sell your highest position. You actually could, if your highest position is a dividend platform, is a dividend payer, you actually could take all of your dividends and put it towards your other positions. You can take any money that you're adding to the stock and also put that towards your other positions. So let's say your best performing stocks are 20% stocks. And let's say that those 20% stocks are paying you over $1,000 a month per stock. If you got two stocks paying you over $1,000 a month per stock, then that means that you could take $2,000 a month and add it to other stocks. You will put it on a stock you don't have, or you will put it on a stock that does not perform as well as it used to. Because when that stock uh, uh, returns to its normal levels, it will experience growth. Where if you're shaving off the top for growth, you can shave off the top for growth, buy back in when it goes down, and increase the quantity of shares that you have in the same monetary value of your portfolio, which, if you're using dividends, will increase the quantity of dividends that you get off of your portfolio, which makes your portfolio more successful. Now, Michael says, start your financial success at 9 years old. Don't wait. Get up every morning and make your bed. Teach your kids work values. And if you don't know, learn it also. I left that up there for a minute because this is the truth. And I'm going to say this for people who don't agree. There are two things, technically three things, but there's two major things that you should teach your kids when they're 7, 8, 9 years old: how to handle a gun and how to invest in stocks. The third thing is the Me Too movement so that they don't get caught up. Them three things they need to know before they get too old to have the law in their favor, right? And if you're going to teach them a fourth thing, is how not to be financially wasteful. But for all of you people who are children born in America between now and 2028, you should be teaching your kids how to invest in that government portfolio and invest in another portfolio that'll do better than the government portfolio, and then be able to take care of their own self with the money that they're getting from you, which, as a parent, if you're providing the child with the money that the child needs to pay for their own needs and you're teaching them financial responsibilities, they'll buy their own clothes, school supplies, and pay for their own field trips, where all you got to do is sign a report card, and the money is working twice because the kid got what they need. The kid feels empowered because he or she bought it themselves, because they earned it themselves. And you don't have to give out extra money just because the child is breathing. And if the child is an employee in the LLC of your household company, that's a tax write-off. So I mean, you can work this out in a lot of different ways where your kids come up to be financially savvy, self-sufficient, empowered, enlightened, self-protected. And if they make a mistake, you can cover them, because the mistakes that they're going to be making with their $50 a month allowance, if y'all giving them that much, is not nearly the kind of mistakes that they will be making with $500,000 worth of inheritance if you left that for them. Think about that. And to remind them that you're old at 18, that you own your own at 18, and ain't nobody coming to save you at 18. I'll put some money on your canteen. I'll come and visit you on Sundays. I'll take a couple of collect calls with your money. But as an adult, you got to take responsibility for you. So the plan becomes even simpler. Now, you gradually sell your single concentrated stock with the proceeds that you buy a few broad market ETFs with. And if you're using an example like a total US stock market ETF for your US exposure, and a total international stock market ETF for your global exposure, and a total market ETF for your bond allocations, you would kind of cover all of the bases with just those. And with just a few purchases, you can be more diversified than someone who spent 20 months picking 20 individual stocks. It's a easy button for building a fortress portfolio. But since you guys came to this and that, where we talk about this, that, and everything in between, I have already selected 40 stocks for you. So all you got to do is just pick the 15 or 20 of them that you like the most. Makes your job so much easier. Michael says, allowance. We all live under this roof. Go set the table. You better go cut the neighbor's yard, walk the neighbor's dog, and watch the neighbor's kid and get some money from next door. Because I ain't giving you nothing. I pay for the food on the table, the clothes on your back, and the water that wash your behind. Everything else that you want, you better figure that out. Look, this is what we were told when we was growing up. You be in the grocery store talking about you want some McDonald's. Parents be like, you got some McDonald's money? Oh, we want a toy. You got some toy money? Parents used to tell us growing up, don't touch it if you can't afford to buy it. No, ain't no coming and tugging on my clothes, talking about some mommy, daddy, can you buy me nothing? If you didn't come to the store with no money, you better not be paying or playing with any of that because I ain't bring no money and we don't steal in this family. You feel me? So that's some of the stuff that the kids just got to get into. Now, once you've built your diversified portfolio, a hidden risk can undo all your hard work, and it's a concept called portfolio drift. Now, let's say you built the ideal portfolio, then your tech stock has a fantastic year. At the end of the year, your portfolio has drifted. You are once again becoming over concentrated in this situation tech. Without you doing anything, your portfolio is now riskier than you intended. Now, the cure for this is the crucial process of rebalancing. Okay. Now, rebalancing is simply the act of getting your portfolio back to its original target percentages. There are two prime ways to do this. He said, "Hey, Mr. Chaos. Chaos is always there. The Chaos Emeralds from Sonic the Hedgehog. We love chaos." Well, one of the things that we like about volatility is that we can profit off of volatility. So some people don't know about that, but I tell y'all all the time when other people act ass, we can make money off of that. We make money off of stupidity. We make money off of weakness. We make money off of desperation. That's called capitalizing. Now, the first method is to periodically sell assets that have grown too large in too short of a period of time and use the proceeds to buy assets that have shrunken too much in the same period. He said, absolutely. This is a system for selling high and buying low, as Michael explained about an hour ago, forcing you to take profits from your winners and investing them in your losers. You can decide when to do this in two ways. First, a calendar rebalancing. This is the simplest method. If you pick a schedule like once a year or every 6 months, and on that date, you adjust your portfolio back to its original target. Me, I'm looking at that bitch every day, every few days, 3, 4 times a week. I looked at it today, which today, Tuesday, first time since Saturday that I looked at it, but checking it all the time. And I check it every day because we're doing a dividend rotation strategy. And every week or multiple times a week, we have a different stock to buy or sell. So I'm checking it every few days. He said, check their pockets and get the money. That's what you got to do. You got to get out there and go get it. Now, a more proactive method is using a tolerance band. Now, you set a range, for example, say around 5%. And when you're thinking about 5%, you're thinking over the course of 20 stocks, each stock 5%, that's 100% of your portfolio. So around your target uh, asset of 5%, you want each one of your assets to stay in that area. If your target for a tech stock is, say, 20%, your acceptable range is between 15% to 25% if you're letting your stock fluctuate a lot. Now, notice when we were watching our stock shift, we were watching our stock shift between 1 and 3%. And in those situations, because we had really cheap stocks, we were looking at hundreds of dollars of increase. If you're trying to catch any significant increase on your stock portfolio, rebalancing it back in the same month while selling will trigger taxation, buying back in will ignite growth. You can do that. But if you just wanted to say, oh, yeah, well, it can fluctuate, I'm just going to leave it alone. But if it gets too low, I'll buy in. And if it gets too high, I'll sell. then if you have a 20% expectation for something like 15 stocks or 10 stocks, then you want to be able to say, well, at 15%, where it's down from 20, where it lost 5%, you want to buy back in. And when it gains 5% from 20%, at 25%, you want to sell. Sell it down to you're selling 5% of your position. So you only act when a sector drifts outside of this balance. Now, if you're keeping it tighter, like I said, 1 to 2% difference. If you're keeping it tighter, where if it dips 1 to 2%, you buy in, and when it rises 1 to 2%, you buy in. You're being a little bit more stringent, but on a month-to-month basis, on a week-to-week basis, you're going to be watching the rise, selling high, catching the fall, buying low, and continuing on a month-to-month basis. So if tech grows to 26%, you would sell that extra 1% and reinvest it into a category that has fallen below its band. Remember to like and subscribe, y'all, because hey, it like, subscribe. If you're watching us from Twitter X, hit the follow button. If you're watching us from Twitch, also hit the follow button. And then hit those heart buttons to show support towards the channel. Now, the second, look, hey, it drug out, and more often tax efficient method is to rebalance using new cash. Instead of selling your winners, you use new money flowing into your portfolio to buy more of your underweighted assets. This new money can come from two sources: dividends paid out to you from your stocks, or new cash that you deposit into your investment account. If you're trying to gain more profits off of the growth and you sell, is it the only one in the room? No, you're not the only one in the room. You're more than one people in the room. You're the only person that's buying and selling stock. You're the only one talking in the chat though. Everybody's watching and looking and listening, but they're not actually commenting the way they usually do. That's because we're talking about diversification today. They got a lot more people that like chaos. So they like people talking shit about one another. They like people talking about conflict and making fun of one another, than them actually learning how to build themselves up. So it's an interesting scenario. I actually see these videos gain several hundred views after the show went live, where people like you, Michael, that are more interested in being financially successful, pick the show outside of the live than the people who dive into the show during the live. But there are a lot more people over on Twitter that are watching the platform right now. So I greatly appreciate them for showing the support on the show today, because that is actually pretty impressive. Does it feel like I'm in therapy? Well, we're talking about financial success, and I'm the doctor of money. It is what it is. I'm the doctor of making money make money for you. So here's how it's going to work. Let's say that your target is going to be 10% in energy stocks, but after a tough year for the sector, they now only make up 7% of your portfolio. At the same time, your tech stock have grown to be overweighted. And when you receive a dividend payment or deposit new savings, instead of reinvesting it across the board evenly, you direct it all of that new money towards your underweighted energy holdings. By systematically using new cash to buy what's on sale, you can slowly bring your portfolio back into alignment without having to sell your appreciated assets and potentially trigger capital gains taxes. It is what it is. And these are different ways to make money for you. Because while I did say, yeah, you can take your dividends that you get and the extra cash that you allocate, and you can add that to new stocks or um, um, poor performing stocks. If you wanted to shave off of high performing stocks, you could do that as well to give you even more growth, and then buy into or give you even more profit off of growth, and then buy back into that same uh, stock when that stock goes back down, because what goes up does go down. Now, one of the things that'll be very interesting, because I did say this earlier this year, you are supposed to have a level of standby money in your stock portfolio that is not actually invested in the stock portfolio so that you could take action on buying a stock when a stock is worth buying. So you should have a level of unsettled money and a level of settled money that would be utilizable to take the settled money and buy into your next position so that when your unsettled money clears, you're capable of buying into yet another position. While you're buying into one position, in the same day, you can be selling a percentage of another position, which will then be pending as an unsettled stock, as an unsettled trade. This will lead you into being more of a day trader. Cash reserves. See what Michael talked about? These cash reserves. If this will lead you into being more of a day trader because when you're buying into something else, you're recognizing something else is doing good and you can sell that day as well. You're checking every day or every few days when you can buy something else. Some people can use the Google widgets or Yahoo widgets to show them what the stock market is doing for some of their favorite stocks, where you can have those things switching up on your phone on a regular basis in live real time, or you can just check your fintech uh, check your fintech application, whatever you're using for your trading platform, every moment of every day during the stock market and be like, oh, time to trade. You know what I mean? Because if you check it at the end of the day when the stock market closes, it's not going to move again until tomorrow. And if you schedule it to be the first trade that happens tomorrow, then you have the rest of the day to buy to make the sale or make the buy. And depending on when you buy and when you sell, depends on how much of your position that you bought versus the change in the market while you were trying to buy. The more you're trying to buy, the longer it takes for you to make the buy. And it could take up to 24 hours to complete a transaction, depending on how many shares you have or how much the share value is. So when you start moving 10,000 and 20,000 and $30,000 around, it might take you 24 hours to sell it at that amount to get what you're trying to get. You got to think about that. It's all algorithms. Like your heart, you will know, like a heart attack, especially when your money is going away when you wasn't expecting it to, versus when when your money starts rolling in when you wasn't expecting it to. Now, we've covered a ton of ground, from the dangers of concentration to building a 20 stock portfolio. Now, if you feel a little overwhelmed, don't worry. We've got the portfolio diversification checklist at the bottom of the screen. All of the portfolios all of the stocks that you need. And for any individuals that are interested in the membership, we're going to be I think we have the entire core satellite portfolio in the membership to make it easier for you. You'd be able to go to the membership and talk to me about the step-by-step information that analyzes the portfolios that you're trying to utilize. And you'll be able to talk to me behind the scenes about the common traps that you absolutely have to avoid. Now that you have the blueprint for moving from one stock to 20 stock, I need to warn you about a few common traps. Knowing these is just as important as knowing what to do. Mistake number one, diversification. We talked about this before. The legendary theory of diversification provided by investor Peter Lynch, who coined this term. It's the mistake of selling your one stock only to buy 20 more that are basically the same thing. For example, you sell a big holding in Apple, then you buy Microsoft, Nvidia, Amazon, Google, and 15 other large cap US stocks. You feel diversified, but you've just created a complicated way to stay concentrated on the one sector. True, diversification comes from executing your blueprint and owning things that are actually different. What's the warning, Doc? Yeah, So diversification. So when you're selling your one stock, you're if you're say like for example, we had like 10 or 15 real estate investment stocks out of the 40. You might buy two of those and then buy one of tech and then buy one in healthcare, one in consumers, where you're rotating yourself around, not buying all. Because if you had 100% in real estate investment trust and then you diversify by buying more real estate investment trusts, you're still in one sector. You more diversify yourself by making sure that when you buy a stock or when you sell a stock or when you add money to your portfolio, that the next stock you buy is in a different sector than your primary stock that you own. And you can work your way around all of the sectors, ending up with multiple stocks in the same sector. But if you have three stocks in each sector, you still have four, five, seven sectors. You know what I mean? Where you are diversified enough to where your 15 or 20 stocks are reasonably protected. Now, mistake number two is chasing performance. And this is the hardest psychological trap. Let's say that you build your diversified portfolio, but your old single stock keeps soaring. So you start to feel like you're missing out. So you ditch your new strategy and pile back into that one big stock right at the peak, which isn't smart. As the stock starts rising, I'm going to say seemingly too much, because when it starts going up, it will start going down. So when it starts going up too much, you start buying in at its peak. And that's when you're going to start experiencing the dip. And if you sell at the dip, you're taking an L. But in order for you to turn a profit, it has to exceed your buy-in, which means that it has to surpass its last peak. This is performance chasing, and it's the mortal enemy of a disciplined investor. You have to stick with your diversification plan, especially when it feels uncomfortable. This discipline is what protects you from catastrophic losses. Mistake number three, forgetting about fees and costs. As you start selling your main stock and buying others, be mindful of whatever trading platform that you're using, because there will be costs of trading and taxes depending on what you sold versus what you lost and gained. This is going to be a thing. You're going to have to pay somebody somewhere depending on what you're doing. If you have a fintech application that allows you to trade unlimitedly and you don't have any cost of trading, then you need to focus on your taxation. If you want to minimize your taxation, you might want to sell less and just reinvest more. If you're not concerned about taxation, you might want to reinvest more and sell more and reinvest that. The more you move your money around, the more taxes you got to pay, especially when you're moving your money around on an increase. High cost can act like a constant leak in your financial boat. And this is another reason why using low cost index funds and ETFs is so powerful. You can now build a globally diversified portfolio for an annual fee of less than 0.1%. Okay, which is less than 1%. And there is no reason to pay more than that. When you build your portfolio, always prioritize these low cost options to make sure that your money is working for you, not for Wall Street. Your goal is to move your money around in a way where you're making more money than you're spending after the trade costs, after taxes, and if you're not, then ultimately you're paying someone else to feel good on your platform. And if that's the case, you can just simply get you a World of Warcraft subscription or get you a pre-approved for GTA 6 online and just dump your money somewhere where you can feel good about beating everybody else out on the game. Right? Michael says 11 sectors in the stock market: energy, materials, industries, etc. Right. So if you're trying to get 5 or 7 sectors or 11 sectors, if you're trying to get one in every sector, that's at least 11 stocks with one stock in each sector. And if you're trying to diversify, you might have, if you're getting 15 or 20 stocks, you're probably going to have two stocks in a couple of sectors. But if you're looking at uh, what's going on, Rickshaw? If you're looking at investing in like 3 or 4 good stocks in 4 or 5 good sectors, you're still looking at anywhere between 10 and 20, maybe 25 different stocks that are the highest performing, undervalued, that are going to give you the most money for the least amount of investment. Now, we've walked through the wreckage of uh, fortunes built on a single stock, defined what is a real financial shield would look like, and laid out the exact blueprint for building your own 20 stock fortress. And he asked, do you play video games? Ah, not really. I mean, I do play chess from time to time. I did download Need for Speed on my cell phone, but I don't really have time to play the game. When I was a kid, I used to play video games, but when I grew up, I actually spent more time on trying to make myself successful, and I spend more time working and investing. And when I'm not working and investing, I actually try to turn my brain off and maybe watch a few dozen Netflix videos so that I can stimulate my brain without actually having to think about stuff. So I don't put time into video games like talking about it. Maybe when GTA 6 comes out officially, from what I hear, it's supposed to be in late 2026, I might decide to invest in a projector and a PlayStation, and knock back some GTA 6 because I'm a big fan of the genre. But I don't put a lot of effort into gaming right now because there are no games that I'm interested in. He's off to play chess as well. Hey, Michael, do you play chess.com? Because if you play chess.com, you can give me your username, and then I can try to find you after the show, and we can play some chess if we're not already playing chess with one another, because that would be interesting if we were. Because I got a buddy of mine that he thinks he might win. He said B2 to B3. I got a buddy of mine who looks like he might beat me in one game, but I doubt it because he doesn't he doesn't focus on success. Um, the core message is going to be simple with tonight's show, guys. Investing always has risks. He said, "I'm not old enough to play chess." I'll see you tomorrow, Michael. We'll be here. We'll be here because we got some stuff to talk about with Peru. I think we're talking about tomorrow. I'm not sure. I put it up there. So I've got tomorrow's show already up there, but I forgot what it was. Now we have to remember concentration, putting all your eggs in one basket, is unforced error. It's a risk that you simply don't have to take. Diversification is your secret weapon. It is how you transform a risky gamble on one company into a disciplined process for building lasting wealth. He said, beat myself, especially in the end game. Yeah, yep. I got a buddy that does that a lot. He beats himself on the end game because he be chasing the he be chasing the wrong thing, and I just be sitting there watching like I would have never made that move, but I can't. I can only coach him so much, and then after that, it's up to him. Every now and again, we get a draw, and then he's like, "Oh yeah, I beat you," and I'm like, "Technically, we both lost." But if the best that you get is a draw, I say on a regular basis, celebrate your wins no matter how small they are. So if you went from a losing streak to a draw, you're improving. When you go from draws to a victory, you're drastically improving. When you go from a draw to a victory, that's when I'm really going to start having to play hardball, because right now I'm kind of just like throwing a game every now and again just to see, make some deliberate mistakes just to see how this will work out. Now, If your defense against the unpredictable nature of the market is solidified, a properly diversified portfolio will let you sleep at night knowing that no single event, no single company's failure, no political outrage, no single sector's collapse will derail your entire financial future. You have the blueprint now, and you know how to go from 1 to 20 or from 1 to 3 simple ETFs, whichever one you decide to do. And you can stop being a nervous in your investment future, which is something that a lot of people have to learn. And you won't have to cling so much to one stock and become a confident architect of your own financial future. Because if you're putting your money in more places and you're diversifying your portfolio more often, you're able to receive more benefits from more places. The power is going to be in your hands. So, my question to you guys is, after hearing all of this, what's the biggest challenge that you have faced in diversifying a concentrated stock position? Let me know in the comment section because I read every single one of them. And if you found this helpful, make sure that you hit that like and subscribe button. And more importantly, make sure that you take time to go and hit that notification button on future shows for more content to make you a smarter, more successful investor. Now, what I want you guys to take away from today's show is that look, there is always another way, and we're always looking for that way. There is a large quantity of money to be made, as you can see with the stock changes down below, and those that take advantage of them will by far make a whole lot more on the back end of moving this money around than what they would just working on a 9 to 5, grinding for somebody else to be successful. Because while a lot of people walk away from the stock market screaming that they can't afford it, you also are the same person that goes to your job every day begging your boss for overtime because you can't afford your standard of living with the current amount of money that you make, and you also don't qualify for a raise for whatever reason, whether it's your background, your work ethic, whatever, you're not qualifying for a raise. So instead of forever expending yourself, instead of forever sacrificing yourself for the sake of a company that only benefits from you and they only value you to the magnitude that they benefit, the fact is that you should put more of your extra money towards making more money for you so that you can work yourself out of the job and still have a standard of living that is covered by your investment portfolio. That is the best way to go. Whether you're setting up a vacation coming soon, where you're setting up a change of careers, or you're just setting up the ability to stop working in the next 10 to 20 years. And the older you are, the more you want to put in certain places so that you can retire sooner. Because if you're in your 40s and you want to stop by your 60s, you got a 20-year plan. If you're in your 50s and 60s and you want to stop by the time you're 60 or 70, you got a 10 to 15-year plan. If you're in your 30s, you got a longer period of time to go, but you also have to be dedicated to your financial success. Now, I understand things happen along the way. You have unexpected finances that you have to cover. You have things that you did not want to have to put your money towards that you now have to put your money towards. This means that sometimes you will have to sacrifice your position in your stock market, and you will have to sacrifice your position in your emergency fund to take care of those financial expenditures. But over the long run, you are still supposed to be trying to maintain the largest quantity of diversification of your portfolio to the magnitude where you're investing the most available funds that you don't need to put towards those unexpected expenditures, and put that money towards your capabilities of expanding your growth and your financial savings. Because without that, you're forever going to be working for somebody else. You're forever going to be borrowing against a stone. You're forever going to be at the mercy of somebody else's beck and call, where you will be chasing the dragon or chasing the dollar, where your time and your effort is worth less than minimum wage. And I'm going to say that it's worth less than minimum wage because not only are you driving to the job for close to minimum wage, You're giving up taxation on that money. You're spending gas money to get there and spending gas money to get back and spending extra money on your uniform. And all of that money comes out of the dollar per hour amount that you get, spending extra money on food to eat out while you're at work. And all of that comes out the dollar per hour that you get off of the job. So you're ultimately going out there and putting all of this extra effort in for less than minimum wage. And the question is, why? When you could get paid to stay at your house and enjoy life. And if you were paying taxation on something, it would be on the money that's not moving. Or, well, the money that is moving, because the money that's not moving, anything that stays still for 121 days is not being taxed. So, really, over the $94,000 if you're married and $64,000 if you're head of household, any other money above that, you can dividend rotation strategy that all day long because it would have been taxed regularly anyway. If you're making $100,000 a year or $120,000 a year in returns on your stock portfolio, then that means that you should have about $20,000 or $30,000 worth of dividend rotation strategy because it's going to get taxed anyway. And if you could turn $30,000 into $60,000 on top of your $90,000, and you're only paying taxation on the $60,000, you're good. You're good. So they only gonna take what, 20% of that? I have $70. Well, if you invest that $70 correctly, you can turn $70 into $140. Now, it's up to you as to whether or not you want to do that. Or you could take that $70 and go waste it on a night out and be broke. It's up to you. So what I'm going to say now is, ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So, ladies, please make it make sense. And fellas, we're about 68% male-driven podcast from the male's perspective, and I give you guys all of this information to help you guys become higher value men, not only improving your financial capabilities, but also improving your decision-making skills in your personal life. When you guys work on both, no, you do not have to be. Okay, so specifically based on his most recent question, you can invest however you want to invest based on your own personal preferences and in some situations religious beliefs. You can make yourself financially successful without having to care about your nationality, your social economic class, or your religious background. If your religious background prevents you from investing in certain companies, you can go back to some of the shows where Usman and I were talking about different companies that you can invest in that doesn't compromise your religious beliefs. Because he needed non-debt backed companies that he could invest in and turn a profit. And I gave him quite a few in Saudi Arabia and Europe and England. So, I mean, you can go back to those shows and find those non-debt backed companies and invest in those. The fact is that there's always another way. If you look for it, there is always another way. But a lot of times, if you don't know what questions to ask, you don't know where to find the answers. So I give you guys all the information that you need, which is publicly sourced information to help you guys pay for this, to find the information to pay for the standard of living that you want and make the appropriate decisions that you need because your personal life impacts your professional life and your professional income impacts your personal life. So I'll try to help you guys fix both. Now, ladies, this is not gender exclusive information. So you guys can learn, you ladies can learn how to become higher value women as well. And if you're finding a person that has the same values and interests as you do, and they're able to wisely perform the way you would perform, you would now be able to confide yourself in an individual that would be able to work towards the betterment of the both of you. Because in order for you guys to be in a relationship, you guys have to be willing to cooperate with one another. You guys have to be willing to negotiate. You guys have to be willing to work towards each other's success, which is just like what we were talking about yesterday. If you were marrying a foreign woman and trying to get her citizenship and a relationship failed, the proof of the bona fide marriage is the exact same effort you have to put towards communication and working on a marriage. So if the marriage fails, you should be able to see based on the journals and documentations of how you guys feel and treat each other where the marriage went south. But it would still be considered a bona fide marriage. So with that being said, what you guys have to do is you have to find out what you want to change in your life, recognize what changes that you made last year towards this year, recognize what changes you've made this year for next year, and recognize what changes you're going to make for next year, for the year after. This isn't a New Year's resolution. You are building your 20-year plan right now today to hopefully change whatever you don't like about your life so that you can be satisfied about your life. Whatever you don't like about how your society impacts you or how your impact on society is, you make those changes within your control. And when you do that, then you can be more satisfied with wherever you are doing whatever it is that you're trying to do. So, with that being said, I want to thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I'll see you guys tomorrow night.
Chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. Just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.